A final look at the markets. Wall Street plummeted as recession fears are growing. The Dow Jones down 900, the S&P off 2.5%, Nasdaq 4% down. A few bright spots in the sell-off. I mean, there really are just only a few up there, all the usual favorites. Oh, look at that. Oh, I love it when you see them. Exactly what you'd expect. P&G, J&J, 3M, bit of the oil companies, Coca-Cola, all the value stocks. The banks took a bit of a blow as well overall. Dan Niles is with me, founder of Niles Investment Management. It is impossible, Dan, to come up with a reasonable strategy in these markets.
Well, I mean, I don't think it's impossible. I think it comes down to risk management. And it's kind of funny that everybody is freaking out over a 5% drop in the S&P 500 year to date, when the S&P last year was up 23%, the year before that was up 24%. And so what it tells you is that everybody just sort of bought into buy the dip, fear of missing out. They all loaded up on these tech stocks, didn't care if estimates were going up or down. And now, unfortunately, they're paying the price as you're seeing estimates come down. 6 of the 7 biggest stocks in the world.
Let me challenge you. Let me challenge you on that, Dan. I'll accept your premise that the stocks were overvalued and that therefore there was a reappraisal that was going to take place. But what we're seeing is a creaming of the stocks. You know, they've gone through the blender because of uncertainty that is not justified on the fundamentals.
It completely is justified. That's where you're missing it. Because look at 6 of the 7 Magnificent 7 stocks. Amazon, Microsoft, Apple, you go through the list, with the exception of NVIDIA, all of them, when they reported the fourth quarter, they all had the revenue estimates go down. Now, people tend to ignore that stuff when stocks are going up because they always say, oh, I've got this great view of the future and what things are going to look like. But if you look at the actual numbers, they all came down. Now, NVIDIA, where the revenue estimates edged up very slightly, their gross margins were guided below the street for the rest of the year. And so the numbers barely change on an EPS. Right. So absolutely fundamentally driven in terms of the Magnificent 7 getting hit. It's just people want to try to ignore that because those stocks have done so well for the last year.
One would expect when things do, I mean, at the end of the day, one would agree, I think, that these are all excellent companies making good products that have solid businesses. This isn't pet.com.
Well, but you have to remember, Amazon in 2001 and 2002, the revenues doubled and the stock went down 95%. So there is you can't divorce from valuation, and people have gotten used to just sort of ignoring whatever fundamentals are because they've created this narrative that stocks can kind of go up. You look at Tesla as a great example of this. Last year, deliveries for electric vehicles for Tesla went down for the first time in over a decade, and the stock was up over 60%. So, you know, if you look at foreign markets, I'll give you, let's switch out of the US. If you look at foreign markets, if tariffs were a real problem, then Mexico wouldn't be up 7% if you look at that ETF. The Eurozone ETF wouldn't be up 15%. And China's tech stocks, they're up 21% if you look at KWEB. So the Magnificent 7 are down 15, KWEB is up 21. Reason is estimates are going down in the US, Richard.
We will talk more in detail on this because there's a lot more to talk about in detail. I'm grateful to you, sir. Thank you.